which is foreign and exchange. It's coming from the first letter, which is foreign, and the second one, which is exchange. Like I have on my slide now, Forex is coming from two words, foreign and exchange, which is the first three letters here, FOR, and the first two letters from this exchange, EX, is going to form forex. It is the bilateral currency transaction between two countries. If you've ever had the opportunity of traveling from one country to another, you just traded forex. This is because forex involves two countries. It's a business transaction between two countries and not just two people. Now let's base it on country level. If I'm traveling from Nigeria to the United States, I'll have to change my currency from naira to dollars. Do you all agree? Yes. I believe you all can hear me. Let me know if I'm on the same page. If you can hear me, just drop number one on the chat box.
Yeah, we can hear you. We can hear you.
Okay, so it means if I'm traveling from one country to another, Nigeria to United States, I'll have to change my local currency naira to dollars. So I can't spend naira there, and likewise I can't spend dollars there. So I have to change my currency. That point in time when I'm changing my currency to another is what is called forex. So if you've ever had the opportunity of traveling from one country to another, you just traded forex because you have to change the present currency you have to the country's currency you're traveling to, which is you trading forex, which is what I have on my next slide now. You can see exchange of one country's currency to another. So on here I have the euro against the dollar, which is paid against the dollar. Now, what is the forex market? The forex market is traded daily on a trading volume of $7.5 trillion and is over 200 times bigger than the New York Stock Exchange. Here now, I have my slide here. It's traded $7.5 trillion, which is bigger than the New York Stock Exchange, which is $22.4 billion. Tokyo Stock Exchange, which is $18.9 billion. London Stock Exchange, which is $7.2 billion. All combined, the forex market alone is bigger than it, over 200 times. And this is on a daily volume, not weekly, not monthly, on in one day, 24 hours. The next thing is what is traded on the forex market. Obviously, money. Money is traded on the forex market. We don't do two things on the forex market. We either buy or sell. We don't do any other thing, and we trade money. Forex involves currency pairs. This is another misconception. You'll be hearing people saying gold, they are trading gold, they are trading Bitcoin. Bitcoin and gold, they are not forex pairs. But when I present my charts to you, I'll explain more on that. Bitcoin is BTC, which is crypto. While gold is a commodity pair, is not a forex pair. Why is it not a forex pair? Because it's not a legal tender for exchange. Gold is a metal. Bitcoin is crypto. But when we say currency pairs, when we say forex pairs, we're talking of Great Britain pound, we're talking of euros, we're talking of United States dollars, we're talking of Japanese yen, we're talking of New Zealand card, just like we have on my screen here. The major currency pairs being traded on the forex market are number one, euro, just like the euro here on this. Okay, this one, euro. Then we have Great Britain pound, which is for the Britain, Australian dollar for the Oceanians, United States dollar, Swiss franc, which is coded with CHF, Japanese yen, JPY, NZD, which is New Zealand dollar, and CAD, which is Canadian dollar. These are 1, 2, 3, 4, 5, 6, 7, 8. These are the 8 major currency pairs that are traded on the forex market. If you're wondering why Naira is not there, Naira is not traded on the world stage. Why? Because of the exotic pair, is an exotic pair. We'll be moving to major and minor currencies soonest. Why Naira is not traded on the forex market. So currently now, this is the currency exchange booth. Is the changes in this currency rate that makes you and I money. So now, just like for example, now this is the euro where we buy 1.3970 and we sell 1.25222. It can never be the same thing because if it's the same thing, you and I cannot make money. So it's the fluctuation in prices of these currency pairs that makes us money. Either we predict to the buy or to the sell side. So just like what I have written here, it is the fluctuation of prices in this exchange rate that allows the banks, the major banks, the hedge funds, the speculators, the individual trader like you and I to make money. We tend to buy low and sell high at every point in time. So it's either we are buying or we are selling. Just like I said, these are the two things we do on the forex market. It's either we are buying or we are selling at every point in time. We are not doing any other thing. So if our prediction is right, if our prediction is right, either to the buy side, we make money, and if our prediction is wrong, we lose money. So that is forex for you. So the next slide I have now is currency pairs. When we talk of currency pairs, we're talking of two currency pairs. If I just say currency, I'm talking of one currency. And if I'm talking of currency pair, I'm talking of two. So when we talk of lone or single, we are referring to one thing. But when we talk of a pair, we are referring to two things, just like a pair of trousers, a pair of shoes, a pair of socks. So we're talking of two things. In this case, currency pairs refers to two currencies being traded side by side with each other. And it's worthy of note that it has been written like this by ISO, ISO, which is International Standardization Organization or International Organization for Standardization. They are the ones responsible for the formulation of currency pairs. So just as we have GBP, USD, you can never see it as USD, GBP. It is always GBP, USD. Why? Because this is how it has been formulated by the ISO, International Standardization Organization. So GBP stands for Great Britain Pound and USD stands for United States Dollar. Likewise, we have AUD, USD. You can never see it as USD, AUD. It's always AUD, USD. CHF, JPY. You can never see it as JPY, CHF. It is always CHF, JPY, just like that. So the first two letters represent the country's name, while the last letter represents the country's currency. Example, just like what I explained earlier, GB, which is Great Britain, stands for the country, while the last letter stands for the currency, Great Britain pound. USD, United States dollar, US, stands for the country, while the last letter stands for the currency, AU, Australian dollar, and the likes like that. So JPY, JP, Japanese, then Y stands for the yen, which is Japanese yen. Another pair you'll be wondering is CHF, which is Switzerland franc, Swiss franc, like I have on my previous slide there, Swiss franc. So this one they have
Yeah.
historic reason why it is written as CHF and not SW and not the normal SWF. That's because this Confederation of Analytical Franc, they have a bit of history on why the is written as CHF, which I don't want to go too deep just to bore you about the class. So now the next thing we'll be talking about is base currency. Please mute your mic, please. Please mute your mic. The next thing we're talking about is base and coast currency. So just like I said, International Standardization of Organization, ISO. This is the body that formulates the writing of currency codes as some examples were shown in the previous slide. Base currency. Now, base currency is the currency to the left-hand side when you are looking at your screen, while code currency is the currency to your right when you are looking at your screen. So base currency is the currency on the left, while code currency is the currency on the right. If you understand to this point, please drop number one on the chat box. Just drop number one on the chat box if you understand to this point. Please let's be responsive because this is an interactive session. I'll be asking questions. If you don't understand anything, just don't be shy. We are all learning. Ask. If you understand to this point, just drop number one on the chat box. Anything you don't understand, just say. Just raise your hand and I will meet you. Okay, it seems everyone understands. If Yeah, if you are good for me to continue, just drop number two on the chat box. Drop number two and I'll continue.
Yes, sir, we can hear you. We can hear you.
Okay, so as I was saying, the currency to the left hand
Mm.
side is Euro US. Okay, I'm using Euro USD for this example. So the currency on the left hand side, while viewing from your screen, is the base currency, which is Euro. Like this one I underlined and is on in italic, is written in italic, while the quote currency is the one on the right hand side. So the currency on the right hand side, while viewing from your screen, is the quote currency. So, like I said, it has already been written like this Euro USD. You can never see it as USD Euro. It is always Euro USD. Now, if you are buying on the forex market, maybe you are buying Euro USD, you're simply saying that Euro will be stronger and USD will be weak. And if you're selling Euro USD, you're simply saying USD will be stronger and Euro will be weak. Which means if you are buying, the market will project to the upside, and if you're selling, the market will project to the downside. So this is a graphical example of what I'm explaining. So this means that in an uptrend market, if I'm buying now, I'm expecting the market to have this push to the upside, which is an uptrend, which is buy. And if I'm selling, meaning that USD is stronger than Euro, it should be a downtrend market. So in the forex market, we have three types of market trend: uptrend, downtrend, and sideways trend. Sideways trend I didn't include it because we won't be talking about it for now for because it's the beginner class. So let's just stick to uptrend and downtrend. If you are buying, the market will be in an uptrend, and if you're selling, the market will be in a downtrend. Now, major and minor currency pair. Obviously, like I said before, why are we not trading Naira on the forex market? On the forex market, the world stage, they only regard major currency pairs and minor currency pairs. The major currency pairs are currency pairs that cross with USD, only USD. Like what I have written here, these are currency pairs that crosses with the United States dollar, and they are highly traded on the world market stage because of their low spread compared to others. When I mean low spread, spread is what your broker charges you when you want to place trade. Spread is just like commission. It's just like your normal First Bank of Nigeria. I believe the majority of us here are Nigerians. When you go to deposit in your bank or POS, the charge they charge you, maybe depending on the amount you want to send. If you want to send 5K now, they'll charge you 100 naira. If you want to send 50K, they can charge you maybe 300 or 400. So that charge they're charging you is what we call spread on the forex market. So now, why these pairs are the ones traded is because of their low spread. They don't charge much. Then examples are GBP USD, Euro USD. Of course, every process here that is there is against the USD. USD is either the base currency or the coast currency. Now we move to minor currency pairs. Minor currency pairs are pairs that cross with each other and not USD. The difference between them is just USD. Major currency pairs cross with USD, but minor currency pairs do not cross with USD. These are pairs that do not cross with United States dollar, and they are still traded on the world market stage. They also have low spreads. Example is pound yen, which is GBP JPY. You hear me most times mentioning them like GBP and pound yen, pound dollar, pound card. That's because they expect to be saying GBP JPY, GBP this one, GBP that one. No, no, no. On the long run, as you get advanced, you start annotating those names: GB, pound, yen, pound, dollar, pound card, gold, BTC, Bitcoin, and all that. So example is GBP JPY, which is Great Britain pound against the Japanese yen. GBP card, which is Great Britain pound against the Canadian dollar. Euro GBP, which is Euro against the Great Britain pound. AUD JPY, Australian dollar against the Japanese yen. These pairs do not cross with USD. Hence, they are traded on the forex market. That's why they are called minor pairs. So the next one is the exotic currency pairs. These are currency pairs that are not traded on the forex market. Why? Because of their wide spread. These are currency pairs that are not heavily traded on the forex market as compared to the major and minor currency pair in the previous slide. This is because their spreads are usually very high. Examples are United States dollar against Turkish lira, Of course, what's Turkish lira looking for on the world market stage? We don't trade it, so that's why it's not regarded as a major or minor currency pair. United States dollar against our Nigerian naira, we don't trade it because of the spread, because of their widespread. United States dollar against the Mexican peso, euro against the Turkish lira, euro against the Hungarian forint, United States dollar against South African rand, Great Britain pound against the Hungarian forint. These fall under exotic currency pairs. That's because they don't trade them on the forex market stage, on the world market stage. They are just used as normal means of payment and maybe travel expenses and all. But on the on the world market, they don't trade them. They only trade these currency pairs that is written here, which are the major ones: GBP, USD, Euro USD, and the likes of them. So forex market participants. Of course, the forex market is not even created for you and I, the individual traders. It is mainly for the big banks. When I mean big banks, I don't mean First Bank, I don't mean FCMB. I mean central banks, banks of banks. When we are talking of central banks, banks of banks, the major central banks of countries, the HSBC, Citibank, Chase Morgans, not your regular Wells Fargo that you're familiar with, or Bank of America, something like Bank of America, not Wells Fargo, not so. I'm talking of central banks, banks that are pumping billions of dollars, trillions of dollars, because of the volume that is traded on the forex market daily is $7.5 trillion. So you don't expect you and I with our little $100 to say we want to change the market trends. It's never possible. So the forex market is traded on a very large scale volume of up to $7.5 trillion daily. It is worthy of note that the major movers of the forex market are the major banks. The major banks are the examples of banks I just mentioned earlier, like the Citibanks, Chase Morgan, HSBC, the central banks of central banks. I've forgotten the major name they call them. Let me Google it. Central bank. Okay, I can't really come up with the name for now, though. So, okay, let's continue. So, the central banks of central banks, these are like the major governing bodies when it comes to the forex market. They are the major movers of the forex market. They can just wake up and change the trend of the market. So, if the market is in an uptrend initially, they can just wake up and change it to a downtrend. If the market is in a downtrend, they can change it to a sideways trend, which is consolidating. They can change it to any trend of their choice. They are the major movers of the forex market. So for you and I, which are the individual retail traders to make money on the forex market, you hear this statement a lot when they say the trend is your friend, or they will say follow the trend. So for you to make money on the forex market, you have to follow the trend because you cannot change the trend of the market. If the market is in an uptrend, you should be looking for buying opportunities. And if the market is in a downtrend, you should be looking for selling opportunities. If the market is in a consolidation phase or choppy phase, you shouldn't be trading on the forex market. Why? Because it has no clear direction, choppy market. But they are very good scalpers. We'll still be talking about types of scalpers. These are get out traders. They don't stay long on the market. They just wait for profit. So in order for us not to deviate from the topic, the banks participate on the forex market for two reasons: profit and non-profit reasons. The profit reasons are the examples of Chase Morgan, JP Morgan, the normal banks we have, Wema and all that. They all participate for profit reasons. Then the speculators, the individuals like you and I. Then the non-profit reasons, these are largely influenced by the central banks of central banks. They participate for control reasons, especially the major reason why they participate is inflation. If a country's currency is doing really, really bad, they pump in money to boost the economy. And if the economy is doing, if there is too much circulation of money in the country, they still participate for control reasons. Either they increase interest rates so as people will deposit their cash into the banks so as to control inflation. These are the major reasons why the central banks participate. They do participate for profit reasons too, but their major reason is just for control and nothing more. Major reason why they participate is for control reasons. So next we'll be talking about brokers. Brokers, okay, imagine like the example I made earlier, if you want to send money to another person in another state, we have like POS or First Bank. So either so that point in time where you go to bank to deposit money to the other end user you're sending money to, maybe from Lagos to Abuja. At that point in time, First Bank is your broker. These are the middlemen that annotate a transaction for you. Your buy order and your sell order, they exchange your buy order with someone else's sell order. They exchange your sell order with someone else's buy order. So at every point in time on the forex market, either you are buying or selling, there is someone at the back end ready to exchange your order. If there is no one at all in time, at that point in time when you want to buy or rent sell, the broker takes your order directly to the liquidity, which is the major banks, the central banks, and they exchange your order there and they give you what you ordered for. So either you are buying or you're selling. Don't be scared or shy that, oh, what if I enter the forex market and there's no one selling at that point in time? Or what if I enter the forex market and there's no one buying at that point in time? There is always someone buying and there is always someone selling, because the forex market is always traded every time. So like my slide there, these are the middlemen that exchange your buy order with someone else's sell order or vice versa. If there's no one, okay, of course, I've explained it. If there's no one selling or buying at the point in time, you take your order to the big banks and make the exchange. That is your buy and sell order will be exchanged at every point in time. Now, another thing they do is they provide leverage to individuals to carry out a business transaction. On a normal forex scale business, we are not even supposed to be trading because it's not for us, it's for the big banks. So for you and I to be able to carry out a transaction, we need something called leverage. Leverage is an amount of money that the broker gives you to carry out a transaction. Supposing you have for you to be able to place a trade on the forex market, you need 100,000 units of the base currency, which is GBP USD. So, for example, you want to buy GBP USD, one lot of GBP USD, you need 100,000 units of the base currency. So, for example, maybe you want to buy GBP USD, you need 100,000 units, 100,000 units of the base currency. So if the current price of GBP USD is 1.27000, this means that you need 127,000 pounds to be able to place one lot of GBP USD. We'll still talk about lot size. So where do you want to see where do you want to even see this money to place one lot for a trade that can either go against you or in your favor? So broker says, don't worry, we'll give you 99% of this money, which is leverage. So 99% of 127,000, then you bring in 1%. That 1% you bring is also called margin. Margin is the 1% you put down to perform a transaction. So let me come again now. Leverage is the amount of money that broker lends you to carry out a trade. So if you have a business transaction of $100,000, broker will say, okay, don't worry, bring in 91%. All this is still done at the back end. It's not like you are bringing money or anything. The money you deposit, everything will be done at the back end. Even if you deposit $50, everything like I explained now will still be carried out at the back end. You won't even know, you won't even see it. It will be done on a MetaTrader. Now, another question you asked is, okay, let me chip in lot size and pips. Lot size now, lot size is the measure of your order's volume. For you to be able to carry out a transaction, you need lot size. Lot size basis in three ways. The first one is um, first one is okay. We have standard lot size. Standard lot size. Sorry, don't mind my handwriting. I'm using mouse. Sorry. We have mini lot size. We have mini lot size and we have micro lot size. Pardon about my handwriting. I apologize. I'm using the mouse. So for standard lot size now, we have 1.00. We have for mini lot size, we have 0.1. While for micro, we have 0.01 to 0.09. Then this one is 0.9. Why this one is to infinity? Why? Because numbers don't have ending. So you can use 10,000 lot size, you can use 50,000 lot size, you can use 100,000 lot size. That is on the large scale trading level. So for standard lot size now, this means that for every pip movement now, pip is the movement of the exchange rate, the smallest movement exchange rate can make. Just as human beings, our movement is calculated in steps. The movement of cars is calculated in kilometers. The movement of what can I think of now? Okay, the movement of cars is calculated in kilometers. The movement of time is calculated in seconds. The market movement is calculated in pips. P I P S. Pips. This means percentage in profit or percentage in points. This is the smallest move an exchange rate can make. So if I take 5 steps to the front side, you say I move 5 steps, right? And if I take 5 steps backward, you say I move 5 steps backward. So if the market moves 5 pips or 5 counters to the front, you'd say the market moved 5 pips. Just for example, now maybe GBP USD moved from 1.27000 to 1.27005. So this market moved 5 pips. And for currency pairs, especially GBP USD, USD, and the likes of them, the pip is the fourth number after the decimal, which is 1234. So this is your pip. This one, the fourth number. While the fifth one is called pipette. Pipette. Pipette is like your second. 10 pipettes make 1 pip. Just as you have 60 seconds, make 1 minute. So pipette is like your second. 10 pipettes make 1 pip. Please don't confuse this. If you don't understand anything, you can drop a message. You can drop a message. I will recap again. And whereas this class will end in 4 minutes because this Zoom session is can only hold for 40 minutes. So pipette is like your counter, your second counter. 60 seconds make 1 minute. Then for forex markets, 10 pipettes make 1 pip. So if the counter counts from 1.270001234. So if this one counts from 0 till 10, it will automatically move to this one. Then this one move change to 1, meaning that GBP USD moved 1 pip. If it continues again and this moves to 2, GBP USD move 2 pips. If this moves like that, so this one again gets to when this one gets to 9 and changes to 10, it will automatically move to the next one. This one will change to 1. It will now be 1.2710. You understand now? So the fourth number after the pip, if you don't even understand anything in this class, just understand that the fourth number after the decimal is your pip for currency pair. But the case is not so for Japanese yen. Japanese yen, they have their pip on the second number after the decimal, which is 1.274. So the second number after the decimal is your pip for Japanese yen. When I mean Japanese yen, I'm talking of pairs like GBP, JPY, anything that has JPY, USD, JPY. So the second number after the decimal is your pip, but the third one is your pipette for JPY pairs. But for any other currency pairs excluding JPY, I'm talking of Euro USD, GBP USD, USD card and the like, the fourth number after the decimal is your pip, while the fifth number after decimal is your pipette. So if there's anything you don't understand, please let me know. And the next thing we'll be moving on to is Forex market hours. When can I trade the Forex market hours? Can I just trade anytime I so wish? Can I just wake up midnight and trade the Forex market and make money? So the Forex market is divided into four sessions. For this case, I'll be using, because I don't have the slides, so I'll be using my normal Google Chrome. The Forex market hours is divided into four sessions. Number one session is Asian session, New York session, London session. Okay, for this Asian session, we have two actually. We call them Sydney, Tokyo, New York, and London. These are the four active sessions. But these two sessions, we call them Asian session because they are the Asian pairs. While this one, the first one is Sydney session, it moves with AUD, any pair that moves with Australian dollar. While the second one is Tokyo session, this moves with Japanese yen, which is the JPY. Then the New York moves with anything United States